Hello, and welcome to the Understanding Indexed Insurance Products presentation. Over the past 10 years, the financial market has seen tremendous interest from consumers regarding indexed insurance products. In this presentation, we will share with you the basics of these products and where they fit in today's environment. First, indexed products are issued by insurance companies, and these products provide a layer of safety and guarantees not found in many competing products. These are fixed products, so any money you place into these contracts or any earnings you receive are never subject to market losses. Second, because indexed products are fixed products, they provide underlying guarantees that are backed by the financial strength of the carrier issuing the policy. Regardless of what you may have heard recently in the media, the insurance industry is one of the strongest in the financial markets sector. The reason? These companies are regulated by state insurance departments and must comply with many regulations to ensure the company has the financial strength to meet its contractual obligations. As mentioned earlier, the performance in these contracts is based on the upward movement of an external market index. The first point I'd like to make clear is that at no time is the purchaser of these products making an investment directly into a market index. These products are insurance policies, not an investment. Since the consumer is not placing money either directly or indirectly in the stock market, that can be a real benefit to the consumer. Instead, the insurance company is simply using an external index as a benchmark for crediting your account when the markets go up. If the markets go down, you do not experience the loss. And in just a few moments, we'll provide an example to show you how these products work. But simply put, when the markets go up, the performance in your contract also goes up. But when it goes down, you don't lose a penny. You may be thinking to yourself, this sounds too good to be true. I don't invest in an index, but I can mirror the performance without risk. There is one feature to these contracts that needs to be covered. The upside potential you can earn is limited, but that's not a negative. It's actually a positive. It's because of the limit on the upside potential that the insurance company can offer the outstanding underlying guarantee and never put your money at risk to market loss. Most consumers purchase index products because of the guarantees and want to know that when they need their money, all of it will be there. If you want to take risks with your money, index products are not the right place. These products are for people who do not want to take unnecessary financial risks. The next logical question is, what are the caps? The insurance company indicates the maximum amount of upside potential, and this cap varies from company to company. Some products may offer caps at 6%, others at 10%, and some as high as 15%. With indexed products, the caps vary from company to company and even from product to product from the same company. When you consider the performance potential of an indexed product, it's safe to say that a product with a higher cap will oftentimes provide you greater potential than one with a lower cap. Let's consider a hypothetical illustration. Most index products offered today feature an annual reset with an annual lock-in provision. In these contracts, on the policy anniversary, the company does two things. First, if there are positive gains in the index, the company locks in those gains, and those earnings cannot be lost due to future market decreases. The second obligation of the company is to reset the starting point so we can track the next year's annual performance. So in our example, let's say we start with $100,000 and we're looking at the movement of the S&P 500 in red and an indexed product with guarantees in blue. After the first contract year, if both go up 10%, we see that both have a value of $110,000. When the index goes up, we see the benefit of the annual lock-in. Now, if over the course of the next year the index lost 10%, the index value would go down to $99,000. An interesting point to make here is that even though we lost the same percentage, we actually lost more money because the percentage loss was applied to a higher number. Now, when we look at the indexed product, we didn't experience a loss to our account value, even though the index went down. Our account value stayed at $110,000. In year 2, since the index went down, we now see the power of the annual reset should the index rebound. Then if in year 3 the index gains 8%, both lines go up by 8%. Since we avoided just one down year, we wind up in a much better place financially in lock-in and reset. The annual lock-in protects our principal and gains from current and future risk, and the annual reset allows us to use the lower starting point so that if the market rebounds, our account value will see the additional return. Now, let's look at a simple example depicting the annual movement of the S&P 500 and an indexed insurance product. In 1998, starting with 100,000, at the end of the first year, the S&P 500 gains over 19%, and the index product gains 12%, since our cap in this example is 12. If you remember, in 2000, the market corrected and dropped over 5%, bringing the value of the S&P 500 down to about $113,000, whereas our indexed insurance product didn't move thanks to the annual lock-in. The following year, we saw another slide down of over 13%, moving the S&P 500 to just under 98,000. In 2002, the market makes a fairly significant correction of over 17%, moving that value down again, but we avoided another loss thanks to the annual lock-in. Now this gets exciting. In 2003, the market made a dramatic comeback and posted a positive return of more than 13%, and we see the movement becoming more dramatic between the indexed product that could take advantage of the annual reset. This trend of positive returns continues, and if we just stopped in 2007, they both look good. But then in 2008, we saw another negative movement of the S&P 500, while the indexed insurance product benefits from the annual lock-in. On an average return basis, the S&P 500 looks okay since we only lost an average of 0.84%, and in the indexed product, we saw an average return of more than 5.9%. But unfortunately, we don't earn average returns. We all earn real returns. Looking at the real returns tells us a different story. In terms of real returns, the S&P 500 lost almost 30% over the initial amount of 100,000, a hypothetical walkaway value of just over 77,000. Whereas with the indexed insurance product, we saw a real return of over 74% and walk away with more than 174,000. Which value would you rather have at the end of 2008? Here are your next steps. First, speak with your trusted insurance professional about your needs and personal situation. Then, read all marketing materials and product disclosures prior to making a purchasing decision. Indexed insurance products may not be suitable for all clients, and only a licensed insurance professional can help you make an informed decision. Last, act now so you can make the most out of life.